Hello everyone, this is Charles D'Alessandro with Fillmore Real Estate. I'm sitting here with Tony Seta from Continental Home Loans, and I was just discussing with him about the first thing a first-time home buyer would do when they are looking for their first home, obviously. What's the first thing to do? And I always tell people to get qualified by a mortgage professional, and I have Tony here to go over some things. Tony, what would I do as a first-time home buyer? I don't know anything. I'm just starting, and what's the best thing for me to do before I start looking for a home?
Okay, it's a process of being pre-approved. We can walk the first-time home buyer through it. It involves, number one, running a credit report, which can be done in a matter of moments. That'll indicate a borrower's creditworthiness, or it'll highlight problems that need to be solved. The second element is to document a borrower's income. Things like pay stubs, W-2s, and tax returns are gathered. We analyze them to determine the countable income these documents show. And then the third element is assets. Assets in the form of savings accounts, checking accounts, retirement funds, whatever monies the borrower has that they're going to need to buy the property. So those three elements, credit history, income, and assets, come together to form the basis of a mortgage approval. If a first-time home buyer has these documents, does the credit check in advance, they can shop intelligently for a house that's within their means. There's no point in looking for a $500,000 house if you can only afford $400,000. So this preliminary work we do, which often results in a written pre-approval, enables a first-time home buyer to shop intelligently and look at the proper price range, knowing full well that they are pre-approved once they find a house of their choice.
Well, we're hearing today how hard it is for borrowers to borrow money. What are the biggest problems that you're seeing? I guess it is the credit.
It is credit.
So if my credit is not good, what would be good credit? And if it's not good, can I improve it?
Exactly. Well, that's exactly why we want to run that credit report, because it may be acceptable as it is, or it may not. It depends. If it's not acceptable, what we're going to do is point out the flaws. We're going to point out those issues which need to be addressed, whether it's a collection account that has been paid but is not reflected as paid, or whether it's a delinquent account that needs to be brought current. Whatever the credit report shows is something we address in an attempt to improve the borrower's credit to the point where they qualify for a loan.
Now, if I'm buying a house with my family, and it's my wife and myself, can I bring someone else in as well to help me with the income?
As
you
well,
know, my mother maybe wants to live with me. She has Social Security or pension.
That's a perfect example of what is viable. Someone buying with a relative, their mom, who's on a fixed income, that income can be counted as long as that person is going to occupy the property. Yes, a husband, a wife, and the mom can be processed together. So there's three incomes, there's three sets of credit, there's three sets of assets that are looked at. And that is not an unusual thing with first-time home buyers, to see a relative joining them in the process.
Now, I have the down payment, but the closing costs are another thing. How much are closing costs, I mean, generally?
Closing costs approximate 5% of the loan. There are a couple of ways first-time home buyers can maneuver to qualify. One is to get a gift from a relative to cover closing costs. And the second technique is something that's used very often in conjunction with FHA loans, and that is what's known as a seller concession, whereby the closing costs, some or even all of them, are built into the purchase price and are paid by the seller on the borrower's behalf. That frees up the buyer to come up with merely the minimum down payment.
Now, that's not paid by the seller. It's actually paid, built into the loan, paid back. It's not the seller taking that out of their pocket.
It's built into the sales price, and which of course means it's built into the loan. But it's primarily built into the price, so that it is the seller who pays those expenses out of the higher purchase price.
And the bank's aware of what's happening here.
The bank is totally aware of it. It's in the contract of sale. The purchase price reflects a seller concession.
And that would be an FHA loan, I guess, for federal housing.
That is the typical way concessions are done with FHA financing, which has become the dominant form of financing today. which requires a minimum down payment of 3.5% of that purchase price.
Tony, now, I know a lot of people are going to see this and I'm going to say, well, how do I get in touch with you? So maybe you could just make a little commercial here for yourself.
A couple of different ways. The best way, of course, is by cell phone. My cell is 516-382-4791. Or by email. My email address is acetta, that's A-C-E-T-T-A, at cccmtg.com. So cell phone, email, preferred method. My office number is 516-634-1200. Readily available by cell virtually all of the time. And we'll conduct a quick interview by phone and see if we can set up an appointment to go over the three things we just discussed: the credit, the income, and the assets, in order to see how far we can go with this potential borrower.
Thank you. This is Tony Setta from Continental Home Loans, and he's been in the business for well over 25 years and basically knows everything there is to know about mortgages. If you have any questions, don't forget you could always call Charles D'Alessandro of Fillmore Real Estate as well. And my number is 718-253-9600, extension 206. Thank you very much and have a great day.
Hello.